that we can understand is sales generated. These 12,400, I would assume this will be uh, uh, sales return. And let's see if that is the truth. Yeah. And as you can see, it's clear here that there was sales return here of this amount. So we just going to take the sales, we deduct the sales return, we have the sales that was generated for that particular year, ending on the 28th February. You did a bit of accounting in the first year, so this should not be a problem to you. Okay, so less cost of sales. We know what the cost of sales is. Then we obtain our gross profit. This we can call it the gross profit of the business. The color is not what I was expecting. It's quite all right. Here we go. So we have a gross profit, and now we come to other operating income. Okay, so other operating income, the rent that we received, and and the credit losses that were recovered, all this will be a plus, not a minus, because this is money that came, that entered, that this is an income, right? This is a positive, this is not a negative. So that's why we need to add this to the gross profit in order for us to obtain the gross operating income. So we adding all operating income, not operating expense, but operating income, but minusing the operating expense. And what will be the operating expense? Of course, insurance, rate and taxes, wages and salaries, repairs and maintenance, advertising, telephone, printing and stationery. So all these, sorry about that, all these will be our operating expenses. Here we are not adding interest because I told you interest is in its own category, a different category. So now let's go to the financial side of it. Once we have made all this calculation plus operating income minus operating expense, what we get is the operating profit. Remember again, profit is always income minus expense. It is profit. And that's what happened here, is that we look at our operating income, we added our operating income minus our operating expenses, and then we have our operating profit. Different from gross profit. These are two different things. The gross profit is not taking into account operating expenses and operating income. Okay, so now we come now to this item, the interest. We add the interest income. Once we add the interest income, we have the profit before interest expense. Here it is. So here there will be also another plus and minus. Plus interest income minus interest expense. Plus interest income minus interest expense. Then we can get our profit before tax. That's quite a good place there to be. So our profit before tax, obviously, as you know, From what we have before tax, we're going to calculate what tax amounts we need to pay in terms often of percentage. So most of the time, 28%. 28% of this amount, once we minus the 28% of this amount, we will obtain our net profit. And this net profit will either be retained, what we call retained earning, in order to grow our business, in order to invest in other assets, or it's going to be distributed, which we call dividends. But the net profit is quite important because, for instance, when we want to find the net profit per share or the profit per share, we use this amount here, net profit. Okay, so I know that our time is we don't have the luxury of time and we have to move quickly. So as you go, there are other examples, couple of examples that you can use to try to properly understand. Um, what I wanted to come to is the taxation expense here. So for instance, in this example, we have a 570,000 as our profit before tax. And you can answer this question, taxation expense. Then always look at the given. It was said here that the tax amount was calculated as follow. It's a 28%. So in this case, we can look at the 28% of 570. I should be letting you do this at home. It's quite simple. Um, Let me see if I can reach out to my calculator. Unfortunately, I don't have a calculator on the screen there, but have a good calculator with you and even maybe a financial calculator with you. But then when we say 570 times 0.28%, then the amount here should be 159,600. And then we can minus 570 minus 1596 and the profit after tax. This is the profit after tax. Oh, I was talking about the net profit. Profit after tax sometimes could be the the um, the net profit, uh, and you just need to be careful because depending on on different people, you will see the profit after tax or the net profit. So the two should be fairly similar. All right. And so we have the shrinkage. Shrinkage is any other things that any other loss that is incurred by the business that is attributable to theft, shoplifting, breakage, obsolete inventory, inventory rotation, natural disasters, or administrative error. So there is always things that falls through things that fall through the cracks, and so you need to also account for that. And that's why businesses work hard to minimize those shrinkage. All right. I think you can have a good read on this one on the perpetual inventory system. Many businesses are using the perpetual inventory inventory system that allows to track the inventories at any point in time. But also you have the periodic inventory system. You should just know the difference. So this is quite important because when you have a period, when you're looking at the cost of sale, you might be required to make a calculation to find really what is the cost of sale. Okay, so you look at the opening inventory. Remember that the cost of sale comes from the inventory that we bought. Uh, uh, so the inventory plus purchases, the opening inventory, let's say last year there was an opening inventory plus purchases plus carriage, relage, freight on purchases, import tariffs, plus custom duties. All those need to be added, but minus the closing inventory. Why? Because this cannot be taken into account because it was not sold. So the it should not be taken into account into the cost of sale. Remember, it's a cost. So whatever is a cost is added plus plus plus, and whatever is not a cost is minus. Okay, the same is for shrinkage. Shrinkage inventory losses should be debited to to cost of sales. I know it's difficult sometimes, the debited and credited. So according to the International Accounting Standard, inventory losses should be debited to cost of sales, deducted from the cost of sales, because it's not going to be used. It has disappeared, so we need to deduct that from the cost of sales. Right. So yeah, please, the analysis and interpretation of financial statement, very important. This is our second part. So for the uh, uh, 20 minutes that we have left, I'm going to touch on this, and this is going to be quite a very comprehensive video. And what is important is that I would expect you, perhaps you might not be able to go to go through the whole video at once. No problem. I think I might even divide the video in a couple of more videos, but that's not important. As long as you you know that it's a long video, and I had to do this long video in order to cover already ground, and there is a reason for this, is so that you may not be in a situation where you feel yourself late, or at a disadvantage. So for all of you who are going to be going through the video, and the many others who are really going to uh, if I can say, who are going to um, join, um, I'm just checking my sorry, I was just checking my connection. So hopefully the video will be of good quality, because I'm not too sure why my connection is a bit low. Um, but hopefully it's a video. So ratio analysis, it's quite important that ratios are used by everyone: the management, the owners, shareholders, the investors, the employees, statisticians, auditors, creditors, and financiers, government. We are all using ratios, but we are using them differently and for different purposes. Some ratios will be more interesting to some people, and others to others. So as you can see, financial ratios are used to quantitatively analyze a business's liquidity, profitability, leverage, growth, profit margins, and rate of return. So this is quite important when we're looking at the solvency ratio. How solvent can the business meet its financial uh, responsibility or liabilities? Can they meet it? And you have profitability ratio. But for solvency, it's quite an important, the solvency ratio, you are looking at the total asset. Can the total asset cover the total liability? It's quite important. So if it can, then the business is solvent, as it says here. The business is solvent. So pretty easy principle to understand. It's just a principle. And perhaps people who would like to invest into a business will look, or people who would like to borrow, not invest, but who would like to borrow. Let's say the bank, they need to look at the business. And that's why sometimes the bank asks for collaterals to say, do you have enough finances that will reassure the bank that in case you are not able to pay your debt, you have enough asset that will be able to cover those debts. Not the best of things. You might lose quite a lot of your assets, your cars, or the buildings, or um, property, could be used as collateral to pay for a business that um, so a business is considered insolvent where the liabilities exceed the asset. All right, so profitability ratio, I'm just going to go down quickly. Important. Why is it important? Because we want to find out how much uh, um, profits we have generated in comparison to a particular item. Let's say, for instance, gross profit percentage. It's going to be the gross profit divided by the total assets. So we are looking at the profit that is left when we're looking at the gross profit, the profit that is left after we've deducted the cost of sales. And when we divide it by the total asset, we are getting how much profit we are generating for the total asset we have. That's why it is times 100, because it should be a percentage, not a ratio like for the solvency ratio. I hope that that's quite clear. I mean, your reading will make it more precise to you, but it is the same as when we talk also about the net profit percentage, because we're looking at the net profit, so we want to have an indication of how much profit is being generated for all the asset that we have invested in. So that I can see investors looking into something like this because they are looking for the total asset that the business has and has invested in. How much profit are they getting? And so and then we have the return on average owner's equity. Very important. This is also very much used into the financial world, especially by investors. They will look into something like this. Sorry, uh, ROE. You will hear much in uh, financial analysis as well as financial reports. You will see things like the ROE. What is it? It's the return on equity. Return on equity. So we are taking the net profit, we divide it by the average owner's equity times 100. So this you can see this is narrower than the total sales, because total sales equal, if you look at the total sales equal at the total liability plus uh, owner's equity, right? And so we are just want to now look at this owner's equity and get a feel of how much net profit we have deducted everything that is to be deducted, expenses, interest, expenses, uh, tax, in order for us to get the very final net profit that the company is making. We divide it by the owner's equity. Right, so these ratios are quite easy and you probably have encountered them, but just reacquaint yourself with them. For instance, liquidity ratio will really tackle the short term. That's why we will look at something like our current asset and a current liability. Current, again, by current, non-current will be long term, current will be short term. Current, short term will be less than a year or a year. And so we are looking at our current assets. If they are covering our current liability, it's a ratio. So it's a current ratio. And the acid test is when we take off the inventory. So we will remain much with the cash there, the cash, because this inventory has not yet been converted into cash. So that's why it is called an acid test. In other words, you want to have a quick fill, of our liquidity. If our the money that we have right now will cover the money that we owe. All right. So then we have asset management, average data collection. Very important, very important. We will look at this. Our datas, sorry, no, um, um, our creditors, I'm talking obviously about the asset management in its all. We will look at our creditors, our debtors. Creditors are the people that borrow us money. Debtors are the people that we borrow money to. Um, So we will look, for instance, at any of our data. We will look at the average data collection period. And our creditors will look at our average creditor settlement period. How fast or how many days does it take us to pay back? That's why it is divided by the credit purchase. How much is it going to take us to pay back? But for our datas, how much it takes our datas to pay us back. And that's why these are different. We're looking at a credit cell, not sales. Remember, we have sales, but we must make the difference between sales on credit plus sales that is not on credit or cash. So that's why it says credit sales. So don't just go and take sales and put it here. You have to get an indication of how much sales is on credit. How much of what we sell out is on credit. We give debts to people and they will be repaying. I mean, all of you would have a credit, a credit um, at a particular store where you can take things on credit. And so we need to get an indication of how much sales is made on credit. Then we look at our average data. Data divided by um, average trade data, obviously. Remember, but the time function will be 365 because we're multiplying by 365, sometimes by 366, depending, but there's not much difference. But you can see average trade creditors divided by the credit sales times 365 because we need to find the number of days. And so it's quite easy, and we have the average inventory turnover. And so all these, there's quite a good example here where a statement of comprehensive income is given, but also a statement of financial position. Remember, the difference between these two statements is that the comprehensive income covers a period, often of a year, but could be less than a year. But the state of financial position is at a particular point in time, not a period, but at a particular point in time. Like that's why you see the difference between for the years ended 28th February at and at. So you can see there. Uh, Sorry there. Let me just erase this. As at. So this is at the particular point in time. And I hope that this is clear to all of you, because this will be like a snapshot picture, to be like a picture of the situation at a particular point in time. This will be more like a movie. This will be more like a motion picture, a movie. So you see the difference between a movie. A movie will have a beginning and an end, and there's a period in time there. And this will be different of just a picture of a particular point in time. So I hope you're making the difference between the statement of financial position, which is the balance sheet, and the income statement of comprehensive income, or income statement. So you see, you would have different way of people calling this, but you should understand what it's all about. Balance sheet. Sometimes we refer to it as the balance sheet. All right, cool. So the balance sheet, as you know, the balance sheet has a simple principle: asset equal equity plus liability. All of you should be aware by now. All of you who have gone through first year should be aware by now. You have the asset, you have the non-current asset and the non-current liability. Sorry, the non-current asset, and then you have the current liability and non-current liability. Current liability and non-current liability, and then you have the owner's equity. Owner's equity. Okay, so this is a good example because it provides you with multiple years, and then it asks you to work on many of these ratios and to understand what these ratios. So remember, it's not only the calculation part. The reason why you have to do the reading is that when you are answering these questions, you need to know what these ratios represent and what these ratios are telling, as saying, because you will be asked to do an analysis. So you need to know the meaning behind these ratios. Okay. And then so we investing in shares for the equity. You have the technical and fundamental analysis. Very important for you to do this short reading. It's quite important because the technical one, it's simple. We'll look at the past trade, how a particular company has been doing, especially when we're looking at its ratio. So that we call a technical analysis, because we're looking at past trend and see if those trend or patterns can replicate themselves in the future. But fundamental analysis is different, because we are looking more at things like the risk, making projections on the business performance, and uh, which we predicting, we valuing the stock uh, and its probable price evolution. Just like I'm sorry here to say that it's almost like, I twisted my tongue a little bit, but there is a difference between the two, because the fundamental analysis will look more at what is fundamental for the business, uh, the uh, not the past trend. So the fundamental analysis will look at what is current. You see, uh, as it says here, can point out here the current price of that company share. So it involves making investment decision based on differences between fundamental values of a company and current price of that company's share. So what is fundamental? I will have again to make maybe the difference between these two. Probably twisted my tongue a little bit there, but uh, um, uh, forgive me if I've made an error there. But it's what is fundamental, not what is current. What is fundamental as opposed to what is current. Right. So that will be it for our session today. There is other ratios, and as I say, just go through the ratio: debt to equity, non-current liability divided by the total equity. They are very simple: total gearing, long-term liability divided by the capital employed. And you must understand why these are important. And this gearing will definitely be looked at by our creditors or by investors. Investors who try to invest in the company will look at this. uh, the price to earning, a very important ratio in the finance world. Many companies will look at the price earning, the PE ratio, where we're looking at the market price per ordinary share divided by the earning per share. Um, when it comes really to the dividend yield, the dividend payout, which is almost at the age of learning unit 2. I think that next week I might send some another audio on this particular point, just to cover some of these points. But a quick read should give you all that is needed. Dividend yield, dividend payout ratio, price to book value, quite important little ratios that you can familiarize yourself with. And the rest of the time, when you would get a question, is basically to understand. We want to know if you understand these particular. So that's quite a good read with a lot of examples, a lot of